Okay, so happy Friday, 23rd of March. I hope everyone is well. Another interesting day in the markets yesterday, another heavy down day. I was just listening to Bloomberg on the TV, and they were saying that at one point the Nikkei was as big a loss that the last time that we saw such a move to the downside in Japan in the local equity market was on the night of the US election, going all the way back to 2016. So we're going to have a quick look at the reasons behind this, and I thought what I would do is go in a kind of a format of explaining the latest kind of TV episode that is Donald Trump and Are You Fired? I'm going to call it. And so this is what we're looking at, and this is kind of one of the main reasons for the sell-off yesterday. And if you think about what we've had this week, you've had Monday was a really big down day in regard to the tech sector. That was when you saw the likes of Facebook shares get hammered, along with other social media names, which obviously those types of stocks tend to be fairly large weighted these days, and therefore net effect is the entire indices start to come under pressure. I'll get round to that in a second in terms of the stock specific movements from yesterday. But then you had the FOMC, and although you could say overall it was relatively dovish hike situation, ultimately this is the sixth rate hike that we've had from the Fed since December 2015. So they are certainly on the way to policy tightening, and that is set to continue. 2 more this year, a couple more as well going forward into 2019. Quantitative tightening also happening. So again, equity markets haven't taken that either in a particularly good way. And then the latest being, of course, yesterday was Donald Trump to impose the 25% tariff on $60 billion worth of Chinese imports. So here he is, the president, doing his kind of Showtime pout that he does. And that's the latest. But what happened overnight? Well, this is what people are generally fearing, is China hitting back. And we heard yesterday Trump, when he was delivering his press conference, was kind of speaking out against Europe, South Korea, even Japan, who's their ally. He's against everyone at this point in time. Everyone's treating the US bad. And then what we've had from overnight is that China have unveiled tariffs of $3 billion on US imports in response to the steel and aluminium duties ordered by Trump earlier this month. So again, it's this fear of retaliation that's really concerning the market. So the trade side is the big thing. Not only that, the conveyor belt that is the Trump team continues to spin, and McMaster has now been replaced. So the National Security Advisor, I don't think this is a real shock. McMaster was someone who was rumoured last week to be in the firing line, and it's materialising, I don't think is as I say, a surprise. But the chap he's been replaced with, if we scroll down, Mr. John Bolton, well, you're going to have to update your Twitter feed, I'm afraid, because Mr. John Bolton is a fairly outspoken individual. To give you a bit of background on this person, he was a firm supporter of the invasion of Iraq in 2003. He has a pretty hard line, certainly much harder line stance than his predecessor in regards to Iran and North Korea. There's a joke that apparently he's known for, is that how can you tell when a North Korean is lying? Well, his mouth is moving. That's actually something he said a few weeks ago. You literally cannot make this stuff up. So obviously Trump's got what he wanted in regards to someone who's going to be on board and is going to fit this fairly aggressive stance in terms of foreign affairs, and this in fitting with the trade talk element heating up. So he's kind of lining everything up in that respect. But it doesn't stop there for Mr. Trump, because we've also had, I don't know if you guys read this yesterday, I found it just incredible. So Joe Biden, who you probably recognise, this chap who served kind of second in command with Mr. Barack Obama. So Trump has threatened Joe Biden, saying that we would go down fast and hard if they fought. Basically, Joe Biden made a comment saying that if we were at high school, I would take Donald Trump round the back of the school sheds and punch his lights out. And then Trump now is in a Twitter spat with Joe Biden, talking about, if you want to fight, let's have a fist fight, and duke it out like men. So just let me remind you, this is the leader of the free world here we're talking about. Then, just to really put the cherry on the cake, Donald Trump has tried to pay for sex with a Playboy Playmate of the Year. So just to kind of really, take it to the next level, it looks like paying for sex with a porn star wasn't enough. He also wanted to book himself in with the Playboy Playmate of the Year in 2006. So, yeah, I don't know if he does this on purpose so that he can say stuff like this about China and get away with it, because you just read all the other headlines and you go, my God, this guy is just on another level. So therefore, what can Trump do that's going to shock you these days? I don't actually know. And is that then a strategy where you can come out and talk, in the type of trade stuff that he's talking about at the moment, could be absolutely detrimental to the global economy, and yet the move is fairly contained, but you can see though it is starting to escalate, and the fact that his team has changed in its composition so drastically in the last few weeks, I think is starting to make the market worry a little bit. Now, if you start looking at the way the market was actually moving yesterday, well, this is the heat map of the S&P 500. Now, as you can see, this week's been a pretty tough week for the equity market. If I just look at the S&P, actually, let's have a look on a slightly broader time frame, just to encapsulate the week as a whole. You can see we've really just gone through episodes of selling pressure. I mean, if I just remove these briefly, let me just highlight the area of activity that there's been this week, and that's the move, and it's a pretty decent one that's seen the VIX go back above 20, which is seen as the kind of the fear gauge barometer of when it's tipping over into a level of increased concern. And so if we look at the percentage moves from where we were at the beginning of the week, we're looking at a loss of about 5% in the S&P, and that's a pretty decent move cumulatively for the week as a whole. Now, if we start looking, if I just again tidy this chart up a little bit, this was that February. So if we go back to here, this was when non-farm payrolls came out in February, and then that was when on that Monday we had that fear about rising inflation and tightening of policy, and the equity markets really sold off. And then this is this latest kind of batch of movement that we've had, really led by predominantly the trade talk and the tech sector, with that Facebook news about what they've been doing with the data harvesting side of things. So yeah, I mean, we're getting down to levels that start to become quite a meaningful pullback in the US equity market when you look certainly in the longer context of these moves that we've had. It's going to get interesting if Trump continues in this fashion. Let's not forget, he still does have to meet North Korea coming up. And now with Bolton sitting at his right-hand side, that meeting's just got a hell of a lot more interesting in that respect. Looking at the heat map, so Facebook was down another 2.7%. The whole tech sector was pretty heavy yesterday. I was looking at Facebook shares. So they're down about 10% on the week, and this is a pretty sizable amount. It probably equates to, I'd say, roughly $75 billion worth of market capitalization lost. And so here we were tracking along quite nicely at $185 a share at the end of last week, before this week took place. But obviously, got to put this in a little bit of context. This is Facebook over the last 2 years, the last 5 years, or in terms of when they first were listed, and it's the biggest pullback we've seen in their stock price ever. Actually, looking at the way in which the stock has gone from really opening up and the initial IPO value, kind of went briefly around 25 all the way up to where we are near circa 200 not so long ago. Other things though this is creating, obviously I talked about the Asian markets overnight were trading very heavy. This came after about 2.5% or 3% loss in the Dow last night. The Japanese yen, so the yen hit a 17-month high as the dollar dips on US trade tariffs. Don't forget that, if you put in the context of the events of this week, you've had a kind of a dovish reaction in the FX market, the dollar, in toward the fact that the dot plots didn't see an immediate jump to warrant 4 rate hikes this year, maybe more aggressive further down the line. And so that's a little bit of dollar weakness by the monetary policy perspective, but also trade wars are negative for the US dollar as well. So the more that this escalates, the more potentially it's going to have an impact on the greenback, and we've seen that certainly this kind of flight to quality move. So consequently the yen strength you can see here going back to, like I said, all the way back to when the US election happened really. A 17-month high for the yen. And if you start looking at gold, look at gold overnight during the US or during the end of the US session overnight in Asia. We already have found we've managed to surmount the R2. We've only really just got underway in European trade. So looking on a daily continuation, this is gold, and we've just got above here the kind of March peak that we had, and going back to February. So this is when the market was seeing that sell-off at the time, the equity market. We kind of rose back higher since that point, but just testing here the early March highs in gold. But you can see over the course of really the last couple of days, we've seen a really nice move to the upside. Beyond here, the next kind of level of interest probably would be that 2nd of Feb move, and then the broader coming up towards this double top, which would be the high of the year, up at 1361. But you'd need to see again a further escalation in the rhetoric coming out of the US and a more aggressive nature, and also in the foreign policy side as well. One thing though that has happened, and that has averted a little bit of a potential crisis, has been US Congress overnight. We've kind of mentioned this as a side note as the week has gone on, but US Congress has approved a $1.3 trillion spending bill. And now this basically goes to the president to sign off, of which I'm sure should be a smooth process. So the government funding bill will increase or have large increases in military and non-defense spending. So it should be expected to sign into law later today and averts then a potential government shutdown. Do keep in mind though, this isn't a long-term solution. This just keeps the US government funded until September 30th. So again, it kind of, I guess, just takes away a risk, at least in the short term. Other things to be aware of today, what I'll try and do after this briefing, I'll try and access the media kind of agenda for the Article 50 summit happening in Brussels in regards to the Brexit situation. This has kind of taken a back seat after we saw that quite meaningful rally in the pound on Monday, after we had the confirmation that in principle a transitional deal has been agreed, where European leaders then are expected to extend Britain's de facto EU membership until the end of 2020, securing then for Theresa May. I think this is probably the only photo I've seen in 2018 where this lady is actually smiling. So I'll let her have her day in the sun, but we'll see. I would say, the age-old saying, it's not over till it's over, and until we have that official press conference, which usually would happen late in this afternoon, anything can happen. I would say the expectation is that, as per what people are expecting, we just get agreement and a transitional deal, at least to continue this process, is secured. So therefore, it should just remain that the gains that have been made in sterling currency, as we can see here. I mean, this was the Monday move on this story, and then obviously we've had the dollar weakness on the back of the Fed midweek, which is this part, and then the Bank of England, which is the final part here. So we have had a decent move from 140 type handle up to around a 140.50, 142 mark. So obviously if the outside, and I'd give it a smaller probability that the deal does break down, there's some renewed issue, which means that they're unable to compromise later on this afternoon, then there's obviously some decent distance to the downside that you could be looking for. I guess downside levels that I'll be watching cable, probably around this point would be the first one, a little bit away from the current price. This is kind of the peak of the press conference that we had on Monday. The retest of that we saw on the following morning. You can see then we've had like before the break came, when we saw the FOMC and the dollar weakness, that was holding price, and it's also acted as support yesterday afternoon. So as we go through, if we continue to come down, you've got that area there from the initial opening price and the late US session low. So these areas I'd be looking at here, any break of that, you've got the 141 handle, and then you go further down. I mean, the broader then levels to the downside, you start getting down to these previous highs that we were seeing last week. On the flip side though, obviously you've got the kind of range high, which isn't too far from the pivot. And so how much more upside we can get if this deal does get, let's say, signed off later on this afternoon, I think is limited. I think what you would need to see a meaningful push on the upside, so if I just remove some of these, if we were to get a break of pivot and a run up towards, I guess, the upper bound of yesterday's price action, if we kind of really remove the spike that came on the Bank of England 7-2 split, then if we're going to get a 140 and above push, it's going to be really dollar-led, I think. And I don't think this is anything to do with the calendar of events. This is going to be to do with the market sentiment around these ongoing concerns about the trade rhetoric coming out of the US administration. If that creates dollar weakness in an environment where I think the Bank of England yesterday didn't shock the market. The brief shock was that two people wanted an immediate hike, but at this point in time, they look set for a May interest rate hike. The wage data is improving, inflation is edging lower, and so this, in addition to the transitional deal, should be supportive for these prices at this point. So the dollar weakness would be what's needed to then bump it up again for another kind of second phase of buying to see off the week. Talking of the calendar, this is what we're looking at. So for Adina especially, you've got the Russian interest rate decision, where you are actually looking for an interest rate cut. Now, I've not had a chance to look at the reasonings from an analyst perspective and why this is actually the baseline expectation, but one would imagine that if, let's say, the US are being quite aggressive on foreign policy, and if you think about the UK upping the kind of a similar kind of aggressiveness in stance because of the situation that happened with that former Russian spy that got killed on British soil, this could equate to further sanctioning on Russian assets, which would be to the detriment of the economy, which was something which defined the Russian economic situation a few years ago. And so an interest rate cut at levels where interest rates are currently at 7.5% could be the reasoning, I would imagine, behind why the expectation is for a 25 basis point decrease. But this is very specific for the ruble. This isn't going to be something which you guys are going to see any impacts on the broader market. What you'll notice is that for this morning, there is absolutely no economic data coming out of UK or Europe. So for the newer trainees, this should be quite telling for where your focus should be for the trading day ahead. Think about the fundamental themes that are driving financial markets right now. The selling has been US led. It's been US led by the tech sector. It's been US led by concerns rising in the VIX index, volatility picking up because of this heated conversations that are happening, and now the retaliation from the likes of China and potentially the EU as well to what Trump's been proposing on the trade front. Everything is being led by the US. Factor in also that you've got durable goods coming out at 12:30. Then really I would be quite conservative with approaching this morning, looking to really take advantage of the opportunities probably later on in the US trading hours. Anyone in FX who trades the loonie, so the Canadian currency, you do have Canadian retail sales and inflation data. This is very impactful for the local currency, but it's not going to have much of a read across into the major broader assets. But I know for some of the trading live guys, this is something certainly to look out for at 12:30. New home sales, this isn't going to be a real market mover, and so otherwise it is fairly quiet from an economic data point of view. Even durable goods, I don't think it's going to have too much of an impact. Don't forget, we're nearly in April now. We're looking at durables from February. And what's really, I think, more key to monitor is overall market sentiment, which has been overwhelmingly negative so far this week. You do have some speakers, though, to be aware of. You've got one of the more dovish members, Fed's Bostic, and is speaking on economic outlook. You also have Flager speaking from the Bank of England. This is kind of central banking 101 tactics. If you think about it, you've had two interest rate decisions of this week, the Fed on Wednesday night, the Bank of England yesterday afternoon. So what typically happens as a strategy is each central bank will layer in several speeches in the days after the initial announcement. Now, thankfully, Powell did a pretty good job at mitigating kind of market potential volatility because he kind of kept this, I guess, continuity of Yellen's approach. And the Bank of England really didn't say much other than the surprise in the vote split. But what you quite often see is central bankers lined up as a fail-safe in case they need to realign markets' expectation. So in this sense, I wouldn't be expecting too much from either of these two individuals, but definitely I would be keeping an eye out. The press conference here, according to this calendar, by the President of the European Council and the European Commission, so this is Brexit time, 1 p.m. London. So do be mindful of that if you're thinking of any sterling positions in that sense. Okay, going to leave it at that and let you guys just get on with things. When Sam comes back to his desk, if you have any questions from a technical point of view, I'll try and get him to jump on the mic and he'll come on and share a few technical setups and key levels that he's looking at as well for the rest of the day. All right, have a good one. And if I don't speak to you before then, have a great weekend. Thank you very much.